in your words, investors are too bearish on China. And when you look at the news flow, you do understand why they're bearish. Do you think they're too bearish still?
Well, I think the broader China markets have some really good attributes, right? In terms of growth, it has a lot of good growth, long-term secular trends in the market, has quite a bit of cyclicality. So the balance is something that we like. Valuations really not demanding. As you said earlier, we've had that big regulatory headwind that it's still not really abating completely. But we think that the global conditions are, starting to turn. With central banks are now, strongly capping the upside, or at least the risk of an inflation overshoot. So that suggests that the global inflation trajectory is probably peaking. And that is going to be laying a ground, we think, for a slightly more constructive backdrop for growth markets and growth sectors. And I think China is definitely going to be one of the beneficiaries as that conditions happens. So I don't think this will be something that happens immediately, but on a trend basis, I think this is something that we'll see play out second half of this year.
All right, and so in terms of sectors, I guess you want exposure to. Let's be a little bit more selective. I know you have some favorites. Tell us what those are.
Right. So I think we are in China leaning a little bit towards the growth sectors going to the second half of this year. So I think, as I mentioned, we're potentially starting to like tech a little bit more. We also have liked consumer discretionary for some time. That is a good balance of those structural secular change like digitalization in China, plus some of the cyclical elements like consumption pickup in the second half of this year. We still have some cyclical positions like financials. On top of the fact that the recovery is very solid over there, there's also the fact that some of them pay pretty good dividends. So it's kind of defensive as well. So I think that at this point, we're looking for a balance, but we've definitely taken off some of the big cyclical overweights over the last couple of weeks.
Okay, Julia, I just want to get your call on some of these big internet names. I don't expect you to name them or identify each individual stock, but we're looking at Meituan, Tencent, JD, Kuaishou. They're all lower on the back of this news. The regulatory crackdown, arguably, it hasn't even really started yet. We had the anti-monopoly push, but now we're talking about data security. Do you avoid these big internet stocks in China?
I think my answer will be twofold. First, I think you have to balance this regulatory headwind versus how much growth potential the internet sector has in China. I think that's pretty obvious if you look at the earnings of these very big companies. They're still growing like they're startups. The earnings net growth numbers are really, really high. So that suggests that the pathway, the room for growth in this sector in China is still very big. So that's the first point. I think that mitigates over time the regulatory headwind. The other thing is, how do you really invest around it? And we do recommend a slightly more diversified approach rather than a very big focus on concentrated names, just to avoid, like you mentioned, having single names very caught up in regulatory scrutiny.
Okay, you talked earlier to David about that balance between growth and value in terms of that exposure. As we head towards the second half, where do you expect to see the earnings surprises coming from?
So we think in China, broadly, earnings should start to improve. We are quite positive on the consumer sector. We think that that has lagged the recovery, but the conditions are in place. If you look at household income growth, they really more or less recovered to pre-pandemic level. Household, consumer appetite or sentiment is improving as well. You can see that partly in the property market. So I think the conditions are in place. It's just a more gradual catch up. But I think that's an area of focus that will be for us the second half of the year.
Okay, let's put your economist hat back on and just talk us through, of course, rates and normalization here. Where do you think the recovery is in the Chinese market, and what does it mean for this tightness across some parts of the liquidity and money markets that we're seeing across that market, which, as we all know, of course, has kept that equity market within a very tight range, Julia, since Feb?
Sure. I think the China market is at a very interesting cross-section right now, because we've had this really big and pretty quick tightening cycles in the first 6 months of this year. So you look at some of the credit impulse indexes, they're actually suggesting that credit conditions really tightened quite a bit. But I think that after all that is done, regulators and policymakers are probably in a wait-and-see mode. So the next step is really data dependent. And for us, I think there are two things that we think have changed at the margin over the last couple of weeks and may continue to play a role. First is that if you look at the export sector, it looks like momentum has more or less peaked there. I wouldn't say that it would fall dramatically from here, probably won't be the case. But to see a further acceleration, I think is quite hard. And secondly, if you look at the inflation prints, look at where commodity prices have been for the last couple of weeks, suggests that probably the peak of the potential inflation worries PBOC may have had first 6 months of the year, look at in terms of PPI inflation, I think that's probably peaked as well. So I think on the back of that, we should start to see a less hawkish policy stance the second half of the year. That should be, on the back of the global conditions I just described, a better tailwind for Chinese equity markets.